Thanks. Good afternoon. Great to see everybody again. Thanks for having me back. Hope everybody's conference is going well. Let's round of applause to the Home Builder staff. Excellent conference. A lot of good stuff going on. I'm going to try to get you guys out of here a little bit early. I know we got some beverages upstairs, and perhaps this talk about the economy will make you thirsty. We will find out. But it's been an unusual 25, to say the least, as we're thinking about the housing market. Mortgage rates, of course, have been hovering relatively high compared to historical trends. We've had sort of a green light, red light with tariffs. This sort of led to the interest rates, led to a really dud of a spring market when you think about sales volume and things like that. And then, oh, by the way, we have a lot of job uncertainty here in the state of Virginia, particularly in Northern Virginia, Hampton Roads. So there's a lot of weaving factors that are happening right now. And so the goal for the next several minutes, we'll try to get you out of here early, but the goal is really to kind of piece that together and have a temperature check on the macro forces that are happening here in the U.S. economy, dive into Virginia's numbers, and then really focus on the housing market specifically, the for-sale market, and then we'll take a look at some of the tea leaves heading into next year. Let's take a look at our economic trends. These are our best way to measure it really is the GDP, our gross domestic product. Anything above that zero means that our economy is expanding. Anything below it means we're contracting. And immediately your eye is drawn to this little dip here in Q1, and I would characterize it more as a blip, more of a blip than a dip. Anybody know why that dipped down there? It was really a one-off. You can see it jumped right back up. It was an increase in imports. So think about it. January, February, we started hearing the tariff talk, and so companies stockpiled their inventory in advance of the tariffs hitting. And so what that did, anytime we are importing goods, what are we exporting? Our money. We're spending our money overseas. That brought our GDP down, and you can see it was very temporary because it shot right back up the next quarter. And that's really because our imports decelerated, so companies were not buying as many stockpiling goods, and also consumer spending continued to go up. And the reason why consumer spending is so important is because it actually is 70% of our entire economy, is us spending money out in the economy. So it is more of a blip, and actually more data came out. We're actually even higher than 3.3. We're at 3.8 for Q2, and you can see it's projected to fall a little bit, but really keep that positive momentum heading into 2026. And again, a lot of that is driven by the consumer. Here in Virginia, we're the yellow line here. This is our GDP. And you can see we follow a very similar trajectory as the U.S. So here's the U.S. going, cranking along. We had our little blip, but we're still in very positive territory. Our economy is still growing, similar with Virginia. Now, we did get a fresh batch of data out recently, and we're at 1.7%. So we've trailed a little bit the U.S., and a lot of that is due to the federal cutbacks and the reduction in federal spending in the state of Virginia. Overall, pretty good shape. Our GDP is in pretty good shape. Now, our consumer sentiment, on the other hand, has been deteriorating. And what this is really how people are feeling. It's not necessarily I spent X number of dollars in the economy, I'm going to spend this next month. It's really, I feel this way about the economy. I feel this way about my own financial situation. It's a series of surveys that are sent out. And really the trend has been downward. If you look at one of these, this is the Michigan index. Here's 25. Actually, it started falling in fall of 24. Really sharp drop here, bit of a rebound, and now we're kind of drifting back down. And so consumers are worried about what their responses are in the surveys generally across party lines. They're a little more worried about their jobs than they were in the past. They're also a little bit worried about inflation coming back. And so what we saw here was this really big dip in kind of the first quarter. And then you can see that rebound. That's when prices did not go up. So people were anticipating, a big bump in prices from the tariffs. They didn't see it, and so they became what I would describe as less pessimistic. So they're still worried about it, just less so. And so when you see this go up, that tends to mean consumer spending is also going to be robust. Now, we've seen it go down. Most of 2025, we've seen this consumer sentiment go down, people more worried about it, but it doesn't always translate into consumer behavior. Consumers are still spending, even though they say they're worried, even though they say they're worried about their jobs, they're worried about prices going up. This is real data. They're still spending. It's actually increased this year. It hasn't gone down. And so that has, going back to that GDP stuff, that's what's propelled our economy forward mostly, is you and me still spending our money out there in the economy. So they call it, there's always going to be a little bit of a disconnect between what people actually do and how they say they feel. So consumer spending in a pretty good spot. GDP in a pretty good spot. Let's take a look at jobs. Jobs are very, very important when you think about the housing market. Jobs are a product of demand in the housing market. And the old adage, as they say, a home is where a job goes to sleep. So if you have more jobs coming, you're going to have more housing demand and vice versa, okay? So in the U.S., a little bit of slowing job market, I would say. Most of this year, if we look at it, just this last August, about a 22,000 job increase, which sounds like a lot, but when you think about the entire U.S., it's actually pretty flat. We're seeing 100, 200, 300,000 jobs added every month. It's certainly slowed down, and this bar chart represents the net change in jobs. You can see very tall bars here as we're kind of recovering from COVID, even well into 2024, and then 2025, it's been a little bit of a pullback here. And this is, a lot of companies are kind of hedging against potential impacts of tariffs. They're pulling back some of their hiring decisions, maybe pushing pause on some, maybe eliminating some unfilled positions, things like that. Here in Virginia, though, we have a little bit different story. This is where we sort of kind of pivot from the U.S. trend because of our concentration of federal jobs and federal contractors here in the state. So we had a little bit of a rebound in August, but I do believe it's going to be kind of short-lived. So you can see this is Virginia's numbers here. Again, this is net change. So the way you read this, 7,000 jobs added net in August. You can see we had a pretty big dip there in June, but relatively flat compared to where we were a couple years ago. And really what has been driving this, and we look at by sector in Virginia, this is net change year to date. So starting in January, if you compare January to August, we have lost almost 12,000 federal jobs, direct civilian employment. We have lost about 10,000 professional technical services, most of which are your contractors, your federal contractors. Two very big sectors for our economy. These tend to be higher wage jobs. They tend to be your homeowners. And then these losses have been offset by these gains here. A big jump in construction, a lot of kind of road construction, industrial construction. The housing construction has actually slowed. So most of that is other sectors here. Healthcare continues to be a shining star. 10,000 additional healthcare jobs added to our economy. So you can see the net change here is relatively flat. Now, if we look around the regions, not a shocker here, Hampton Roads has really been hit the most. They've lost about 5,000 jobs so far through August, and really the federal government and the military it's their bread and butter. I mean, that's most of their economy, and they've seen cutbacks. Northern Virginia is a little bit more diversified in their economy. So the federal cuts have been offset by other industries to some degree, but still flat. I mean, 200 jobs is a drop in the bucket for the size of their economy. It's basically flat. And really, the Richmond region is where it is at right now. The Richmond region continues to outperform the state, continues to outperform the nation, is one of the most sought-after metro areas in the country right now. So Richmond continues to grow. Winchester has been the fastest growing population in recent years here in the state, and I suspect that's going to continue. But you can see some of the other smaller metro areas, your Charlottesvilles, your Lynchburgs, continue to post positive growth. But again, we're vulnerable here in Virginia when you think about us as an entire state, and that is because of the federal employment. We have the second highest concentration of all 50 states. Even much bigger states like Texas, Florida, we have more federal workers than they do. So we are ranked second. Maryland's right behind us. And what this equates to, UVA Weldon Cooper estimated that about 900,000 jobs in Virginia directly or indirectly related to the federal government, whether it be civilians, active duty, or contracting. And so to put that in perspective, it's about 20% of all of our 4.2 million jobs that we have. So about 20% of all the jobs are related to the government. Doesn't mean all those 20 are going to lose their job, obviously, but it does show our vulnerability to that sector. And unfortunately, I don't think we've seen the worst of it yet. If you think about the RIFs, have you guys heard of the RIFs, reduction in force plan? So each agency in the federal government is going through these RIF processes right now, and those timelines have kind of shifted, and so they're still working on how they're going to tighten their staff. And then also the deferred resignations. You guys heard about these? Back when Elon first started with Doge, they offered these deferred resignations, and those folks go off the payrolls today, actually. September 30th is the end of that. And so we're likely to see the federal employment numbers fall even more in the coming months as we get data. But so the worst is not over yet, unfortunately, with the jobs. And UVA is projecting us to really deepen these job losses. We're the navy bar here. The U.S. is the blue bar. In Q3 and Q4 this year, we're expected to see much deeper losses in the federal sector. So those are some headwinds, right? We do have our consumer spending still going for us. Our GDP is still growing here in Virginia. It's still positive. But there are certainly headwinds that we cannot ignore related to jobs here in the state of Virginia. Our unemployment rate is also reflective of this. Our unemployment rate traditionally has been much lower than the U.S., but this has been, we've been drifting up much faster than most places in the U.S. In August, the U.S. is at 4.3, relatively flat. They started the year, we started at like 4.1, so not a lot of change. Virginia, on the other hand, we were down in like the 2% at the beginning of the year. We're now in the mid to upper 3%. Here it is in graph form. You can see, obviously, this big uptick here in our unemployment rate, and this is likely to continue. So there are certainly more people looking for work. When you look at unemployment claims here in the state, 25 is the yellow bar, and it's pretty obvious we're outpacing 24, outpacing 23, and this has been, that kind of gap is widening. So we're starting to see it. It's a very slow thing. It's not an overnight thing, thousands of people losing their jobs. It's very kind of slow churn into the economy, and when people start to lose their jobs, they do pull back on home purchases, big decisions like that, which we're going to get into in a minute with the home sales data. But they also pull back on things like remodeling and really big purchases. And so these are headwinds that we need to keep an eye on, and particularly in the Northern Virginia market and as well as the Hampton Roads market. This shows you the net change in unemployment by state so far in 2025. We are one of the sharpest increases of any state in the nation. All right, inflation. Very important metric to keep an eye on. Overall, it is starting to drift back up. It's not in a bad spot. We're still below 3%. We want to get at 2%. I did this PCE in red because we just got a fresh batch of data on that, and that's really what the Federal Reserve looks at the closest, is the PCE. And the PCE for August, it's not shown here, this increased a little bit to 2.7. And then the core, which, you take out your energy prices, you take out your food, things that are very volatile. You take it out and you get sort of a more accurate read of where inflation stands, and it held firm at 2.9. So it's definitely above that 2% target that we want, but it's not in a bad spot. It's actually not compared to where we were just a couple years ago. You can see it is drifting up here in 25. Some of that is related to tariffs, but really not a lot of it. Those tariff increases are likely more temporary. And so what this has done, we've seen the job market we just talked about sort of deteriorating, slowing down, and we've seen inflation picking back up a little bit, but not really a concerning amount. And so these two forces are really the primary mandates of the Federal Reserve. They want to maximize employment, and they want to keep inflation under control. That is their mandate, the dual mandate, if you hear that phrase talked about. So they met earlier this month. They cut the rate. One of the reasons they cut that rate is because they're seeing these inflation numbers. They're not where they want to be, but they're seeing that they're not really surging, right? It's been very, very subtle increase, but at the same time, they're seeing the job market slow down considerably. So they don't want to risk throwing the economy into a recession from major job losses just to keep that inflation number, very close to where it is now. So they cut the rate a 1/4 percentage point in September after holding it, firm there for over a year, and likely going to see another 2 cuts or so. Well, maximum would be 2 cuts this year of a similar depth, about a 1/4 percentage point in October and potentially again in December. Next year, they originally were positioning, 4 to 6 cuts. Earlier this summer, they were positioning 4 to 6 cuts next year. They've scaled that back to 1, 2, maybe none next year. So the cuts for next year have certainly been reduced, but we are looking, it's all going to be based on data that they get, but likely going to see another cut or two to close out 2025. Let's pivot to the housing market now. So we have data here at Virginia Realtors from all the MLS, the multiple listing services in Virginia. We compile all that data on a monthly basis to get what I feel is the most accurate picture of the housing market here. If you rely on one MLS, you're only getting agents who enter in that one MLS, whereas a lot of agents list in multiple MLSs. And so we get all that data and we pull it together. So let's take a look at what's happening out there across the state. Before we do that, though, we got to talk about mortgage rates because it's a very, very rate-sensitive market right now. And the reason why is it just hasn't really improved, really, since 2023. We don't need to talk about this trauma that occurred in 2022. But really, this has been just like a very stagnant, it's bumpy, don't get me wrong, but average rate 6.8 in 23, 6.7 in 24, and we're at 6.3, just last week. But if you were to average out this year, it's closer to 6.6. So really have not seen a lot of improvement in this, and this has really stifled the housing market. We've seen very sluggish transaction volumes for the last few years, and this is the main reason why. This coupled with increasing prices, it's kind of a double whammy for the consumer. Now, not everybody's impacted by this, right? At least to the negative side of the coin. People who already own their homes are sitting pretty good. They have this thing called the lock-in effect where our inventory, our active listings are being constrained by what they otherwise would be because of these ultra-low interest rates that people are locked into. And one way to look at this is this aqua line is what people have. This black line is what people would get if they were out in the open market. And this is data from the Federal Finance Agency, FHFA. Virginians have about a 4.2% on average interest rate, irregardless of when they originated, whether it's a 15-year or 30-year, just all mortgages. You average it out in the state of Virginia, you get 4.2. if they were to go out on the open market, you're looking at a mid-6s. Now we're at, 6.3, but it's still a pretty big gap. It's like a 2 percentage point gap. But as that gap narrows, which it has, as all the 2023 folks get rolled into this number, and you got your 6 and 7% mortgages in there, you're going to start to see that gap narrow. And when that does, likely to see more sellers coming off the sidelines to list their homes. But right now, this is keeping the inventory constrained. And also, it's been a boon for the remodeling business, because a lot of people are deciding to dip into their deep equity that they have and keep their 2.5% interest rate and just repurpose their home to make it work for them instead of looking for a new one. And so that's there's been positives and negatives. On the negative side of the coin, if you're a buyer, if you're a first-time buyer, if you're somebody looking for property, there's just not a lot of them. It's just been really, really tight because people are sitting on those very low rates. Building permitting activity has also been sluggish. I would define it as sluggish. And really, this is not a new trend. This is something that we've been dealing with here in the state since 08, 09, really when we had the crash. And it has not recovered here in Virginia. We are the dark black line there, the bold line, pretty flat going all the way that, this is like 15 years here. Then we got our neighbors to the south. We got North Carolina, more than triple the amount of permitting that this is residential permitting. Georgia, about double. And they're bigger, they're bigger states, so we would expect them to have more, but 3 times more, it's pretty shocking. And even more so, we got our smaller states, Tennessee, South Carolina, they're also outpacing Virginia, which has almost 9 million residents. So we are much bigger than these states in terms of population, these two. Now, these two are bigger than us. But really, it just shows you it has been relatively flat. And so we've sort of underbuilt our way into this inventory crunch in addition to that lock-in effect that we talked about. Those two forces together have really kept what I would consider an unhealthy level of inventory out there in the market. And as a result, pricing has gone up quite a bit. If we look at it regionally, you can see why it has slowed down. It's really Northern Virginia. The red line there has not recovered since the housing bubble burst in the mid-aughts. It's just been really flat. Really, the growth has been in Richmond over, since the 2010s, the green line there. And then more recently, since COVID, it's been other parts of Virginia, your Waynesboroughs, your Winchesters, your Charlottesvilles, your Lynchburgs. This is where a lot of the new construction has happened since 2020. So it is tight, but the good news is, and if you're an optimist, half glass full kind of person, we really are seeing more inventory hit the market. And anybody who monitors their local market is probably seeing this as well. So there are more listings. Does it mean that it's enough? No, it's not, and we'll talk about those shortages here in a minute. But new listings, so this is sellers who list their homes for the first time. This is percentage change from the last year every month. You can see we've been increasing now almost for 2 years, and this is held firm into 2025 across the state. Definitely more sellers are entering the market. When you look at the local regional levels, really Charlottesville has seen the biggest jump here. A lot of this is new construction, I would suspect. But across, New River Valley, Winchester, double-digit growth in new listings. So we are seeing more activity really across the board. But still, even with the additional listings, we're at a deficit. So months of supply is one way that agents sort of measure, the real estate agents measure the whether it's like a seller's market or a buyer's market. And we're definitely in the seller's market spectrum under 3 months here in the state. We're getting a little bit close to a balanced market statewide, but really nowhere near, 4.5 to 5, I would say would be kind of the sweet spot. Now, when we go around the state, there are places that are getting more balanced, particularly, when we think about our largest markets, Hampton Roads is now in the 3-month territory in most of their local markets. Charlottesville is still kind of at the upper 2s. Northern Virginia is still tight at 1.6, but overall, I would say this is improving. I would say the supply has improved, and it's been one of the bigger stories of the 2025 market in what has been a very boring market. Not a lot of sales happening out there, but there is certainly more inventory. So our team at Virginia Realtors, I got a team with me, and we developed this model to help to just quantify the shortage, because we hear about the shortage a lot. And so we developed a model that estimates how much housing could be absorbed by the population, by the households that are out there. And so we took a look at, using census microdata, we took a look at different cohorts. And you think about people like, your seniors who want to downsize but cannot because there's no homes in their price range or homes that work for them. Think about your long-term renters that have been saving for years and years and years and haven't been able to crack into that for-sale market. So these are all existing households. But then importantly, there's hidden households out there. So there's households that are part of another household. They're nested within another household that would be their own household if they could find a housing option that would meet their budget. So these are, the obvious example is your adults, and they're kind of after college. Now, we're not talking right after college. We give them a few grace years here. So we looked at it from like 25 to 45. Adults, employed, with a decent wage, living with their families. These are potentially new households that are not households because of housing. Think about like different multifamily households. So we have multiple unrelated families living in the same house. They would potentially be 2-3 different households if they could find their own unit and their price point. So we did this study, and we looked importantly at market rate housing. So we're not looking at under market rate housing, subsidized housing in this study. It is a very, very important topic, and there are a lot of people looking at it. We decided to focus on market rate. So 80% of AMI is area median income. All the shortages for folks that are earning 80 and up, right? So for context, who here is in the Richmond market? All right, a lot of folks. So just an example, 2-person household in Richmond at 80% to 120 AMI makes about $70,000 to $95,000 a year. 4-person household in Richmond at 80 to 120, you're talking 90 to 125,000. So relatively good wages, and still the housing is insufficient even at these wage levels. Now, if we look at it around the state, I should back up here. So our top line number really is 188,000 units that could be absorbed by these folks across the state. If we don't do anything, if we keep our similar kind of building permit trajectory, our similar household formations, it's going to balloon to about 214, give or take, by the end of this decade. So 188 across the state. Obviously, most of that is going to be in your bigger population centers. We got 75,000 short, Northern Virginia, 39, Hampton Roads. But even the smaller metros, relatively big number when you think about the annual production in these communities. And I should mention, it's not only production that's going to close this gap. It's also incentivizing homeowners who would otherwise sell their home to sell. So we're looking at different legislation around capital gains tax and things like this to sort of loosen up some of that existing supply, and then also increase the new construction as well to sort of shrink this supply deficit. Now, our home sales activity, I mentioned, has been very boring, and it really, really has. These bars represent percentage change, and we've been negative. I mean, we had a little bump there in May, and I think that was related to the interest rates. There was some improvement briefly in the interest rates there, but really flat. Overall, we're basically net the same as last year through August. And last year was the slowest market we had in 15 years. So really not a lot of improvement. And I tie that back to really 3 things. The reason it's been slower, interest rates have not improved. The job market in Virginia has been very volatile. A lot of folks are worried about their jobs because of the federal cuts. And then the last thing is really pricing has continued to go up, and so people are being priced out, which is why it's really constraining the sales that we've seen. Now, around the state, there are a few exceptions. The Roanoke Valley has been one of the shining stars in the for-sale market, double-digit growth. New River Valley not far behind. Richmond, as I mentioned, continues to attract people. A lot of people from out of town, I should mention. These are not a lot of inter-region moves. These are people coming from Northern Virginia, moving to Richmond. But then you got places like Winchester, which have slowed down a lot, and a lot of the Winchester market, you do see your federal contractors living there. It's a bit of a commuter suburb to D.C. Lynchburg has slowed down as well, and Northern Virginia has been essentially flat in terms of sales activity. A little hard to see it there, but the pricing continues to trend up, but at a slower pace. So we're at about 3.7. 2 to 3% is really kind of a healthy price growth, really, if you look over time. When you think about it, you want it to sort of mirror the slope of wages. You want wages and pricing, home prices, to go up at a similar rate, which has not been the case for many, many years. We're starting to see those lines become a little more parallel, which is, I think, a positive thing. But I would suspect, and we'll see this in the forecast here in a minute, probably going to see price growth continue to be positive, but at a slower rate. If we look at it regionally, we have seen some dips. We actually have seen some dips this year, or in August rather, but overall it's still pretty flat. I mean, Northern Virginia, you hear stories about them, a lot of prices getting cut. Have you guys seen this in the news? And it's the sellers being unrealistic. Honestly, it's they're pricing their properties too high for the current climate. But when they go and close, that sales price is about where it was the last year. So it's been pretty flat there. Hampton Roads has seen a little bit of an uptick, but really this speaks to our inventory shortage still impacting the price points, even with that additional inventory that we have been seeing in 25. So I got a couple scenarios here just to sort of give it a little more context. You hear AMIs, you hear price, home prices, just to give it some context about who is being impacted by the supply shortage and where, because it's very regional. And so this is an example of somebody who makes in that 80 to 120, they're actually 100 to 120 AMI range. And so we got a healthcare worker in Henrico County here in suburban Richmond. And this is real data. This is average wage in 24 is about 82. Now this is across, there's going to be obviously way higher than that and way lower than that. The average is about 82,000. And let's just say it's a one-person household for simplicity. That wage translates, and this is very back-of-the-napkin math here, about $287,000 of purchasing power if they were to buy their unit, or about $22,000 for rent is really what is a comfortable, attainable, not house poor payment. If we go out in the Henrico market, however, it's really a fraction of the market. It's only 18% of all the sales that have happened so far would really be attainable at these wage levels. So it's a very small share. It's not to say they can't find something, because it's out there, but it just means a lot more people are competing for a very limited number of homes in that price point. And this is all related to supply-demand imbalance. Now, if they went out on the rental market, it's a different story. They can very likely find an apartment. Very likely, 92% of the vacant units out there would be affordable to them. Let's take a look at one more, and then we'll wrap it up here and get some questions. So this is in Stafford, and this is a dual-income household. We got a lot of dual-income households out there. And so in this example, we have a school teacher with, public school teacher with an average wage of about 56 in that county, and then a veterinary tech, you're looking at 51 as an average thousand. So you got a six-figure household here, 107,000, which is in the 80 to 100 AMI band for Stafford. Again, this is market rate housing wages. And they could afford about a $375,000 home at their wage levels. And they could, let's say it's assuming a two-person household, so a two-bedroom rent, about almost $2,700 a month for a rental unit. If you go out in the Safford market, you start to see the pattern. 11% of that market is priced at, or went for $375,000 or lower. So it's very slim pickings for this relatively good wage household. I mean, they're making $107K a year, and they can't afford to live in their own community in Safford. Now, they can certainly, or buy in their own neighborhood community. They certainly could rent. I mean, a little bit harder than Henrico's example. You're talking about more than half of the market, but you start to see where, we've seen these broader, and this kind of ties into broader migration trends that we've been seeing, where people are moving they're basically moving to where they can buy, essentially is what the data is showing us. And so a lot of that is in the Richmond market from Northern Virginia. And a lot of people are jumping over Richmond altogether, and they're going to Raleigh. They're going to, Jacksonville, places outside of Virginia. And so it does beg the question of, if we really want to retain our workforce, and we have a very, talented workforce, we continually are pretty high on all of the rankings related to labor force, but we do start to lose a little bit of that competitive edge, as people are moving away. And I think you've seen that. The most recent example would be, we have those business rankings. Have you guys seen this that come out every year? Virginia has consistently been number one the past few years. We dropped to number 4 this year. Went from number 1 to number 4. Number 4 is great. I mean, it's a good spot to be, but it begs the question, what is happening? And a lot of that is due to the cost of living in Virginia. All right, a couple more slides and we'll wrap it up with the forecast. All this sluggishness and everything we're talking about, the fact is it's still relatively competitive. And that is because of that supply-demand imbalance that we have. Sellers, one way we measure this is the average sold-to-list ratio. Sellers are getting about 99% of what they ask for. So it's on the price point. This doesn't include concessions and things like that, but generally speaking, sellers are getting what they ask for. And this is the case in most regional markets. Richmond, Northern Virginia, they're still getting above, over 100% of what they asked for. A little bit lower there, as you go down, but even 98% of it really, when you see this getting to like the low 90% is when you start to know that buyers have a lot more power than they did. But the pendulum is definitely swinging back to a more balanced market, but it's still competitive. Buyers, I hear this from agents all the time. We got 35,000 realtors around the state, and I talk to them on a daily basis. And anecdotally, you start to hear, people can now ask for inspections, believe it or not, which was unheard of just a couple of years ago. A lot more contracts are failing because of these inspections and because buyers do have more options. So it's starting to become a little more balanced, but overall the conditions tend to favor sellers still, and we're almost all the way through 2025. So let's look ahead. Based on all those macro factors that we just talked about, based on the trends in our housing market, where do we see things headed in 2026? So for sales activity, to close out the year, we're on track to just basically be flat. But next year, we are projecting a little bit of an uptick. Now, I will say our projections are much more conservative than a lot of other national outlets. And the reason why is because Virginia, our two biggest housing markets, are likely going to see more pain than before they see the growth. Northern Virginia and Hampton Roads. A lot of people are going to be losing their jobs in these markets. And so when you talk about our total number of jobs, any given year we have about 120,000, give or take, sales in the state. A third of those take place in Northern Virginia and Hampton Roads. So if you have two of our biggest markets slowing down, it's going to pull our overall state numbers down. The reason I bring that up is because there is going to be regions where you far exceed this 5%. There are going to be places that see a big jump in sales, the smaller metro areas. But overall, we're at about a 5% increase. That's about 5,000 or so more sales next year. Price points, we're on track for about a 3.4 to the median gain. And next year, slowing down to about a 2%, which is more in line with a healthy, I think, price growth. Really 2 to 3% is indicative of more healthy growth. Housing starts, not looking too good. Pretty flat this year, and heading into next year, even less so. The reality is there's not a lot of buyer traffic, is what we're hearing compared to other years. There's not a lot of relief on the regulations. There's lot shortages that continue, the labor shortages. You all know this better than me, but it's, from what we're hearing out there, less housing starts next year than this year. And the interest rate, always hard to predict this one. There's so many factors that go into this, guys, so I would take this with a grain of salt, but we're not expecting a big drop. I think that's the key takeaway. Not expecting a big drop in the mortgage rates for a variety of factors, but ending 25, kind of where we are now, it's going to go up and down between then, but kind of low sixes. Might see a little bit more drop at the end of 26, perhaps into the fives. You know, it's still a little early to know, but nowhere near, obviously, where we were. And so I think we sort of reached that kind of new normal of interest rates. You know, I don't foresee a big drop in interest rates in 2026. That is what we have for the forecast. Thank you all for hanging in there. We got some time for questions, and then happy to continue the chats upstairs over some brews. All right, thanks, guys.